Ben, I know you've been waiting a long time. What's your question?
No worries at all. Thanks, Matt, and yeah, thanks for taking my question. I wanted to go back to a couple of questions ago when you were talking about the Graham Fisher, and you were saying about when a company's trading at a bit of a deficit and then trying to regain that, and rather than going decaying and diminishing into nothing. I felt, what are your thoughts about companies, and then I have one in particular, about trying to close that value gap back up to what you would consider your true value or your intrinsic value. I know you've talked about in the past, and I don't know if you're willing to talk about current holdings, but the Naspers process, them trying to regain that value gap back to what you would calculate as their true value. How does it come about that?
So let me try and tackle that. I think there's an evolution to value investing, to most value investors. Most of them start out analyzing financial statements like a CPA would, looking for metrics that resonate well with them, that they understand well, and that they believe are sort of lesser or greater than the norm, whichever is favorable. And they start to do the analysis in that way. And then they realize, here's what the intrinsic value is, and here's what the price is. Okay, there's 30% upside, so they make a decision. We're going to invest. All right. And then they wait for that gap to close. And there's a lot of times, there's a lot of professionals that do this for a while also. We did it for a while. We still, we're trying to do both, but you find yourself in that situation. Sometimes you're surprised to be in that situation. And one simple example I'll talk about for half a second is we owned it for a different reason, but we were long-term owners of these TARP warrants that were sold on General Motors. And, but the longer we held it, even though the adjusted earnings was like 6 times and it looked totally incorrect, it's just a terrible business. It's like a metal stamping business with super low margins, with super high capex. You have to invest it all up front, hope that you guessed what people want to buy in 4 years, produce, millions of them, and then hope they sell, and then you get a sliver. And it's like, the world's saturated in vehicles. We'd love to find solutions outside of that, I think, in most major cities in the world. So, is there, what's the real addressable market? Is it saturated? Maybe. Is it turning over? This is like, you get massive competition in this space. So in general, we actually did fine in the investment because we were using these TARP warrants to do it, but the gap that we expected to close at the beginning never really closed. I think it still trades for like an adjusted 6 times earnings. And I think that their car sales have declined because of all sorts of things, from COVID to supply chain to demand dropping. So that's just an example of sort of the old school Benjamin Graham way of investing. And it doesn't have to be that way. You could find a great business model and apply Graham. But a lot of times the metrics that are show promise, if you're out there just screening, you end up with these businesses that have structural challenges. Maybe their business mode's just deteriorating, and you can't see that on a financial statement very easily. With the Naspers Prosus Tencent scenario, which is quite interesting and fascinating to watch, and there's all sorts of dynamics. I don't think we'll get into all of them, but the difference is that Tencent is growing. So Naspers is at a discount to Prosus, and then Prosus is at a discount to Tencent, and the Naspers discount to Tencent. So high level, in case people aren't familiar, is that Naspers went out and bought about $20 million worth of Tencent maybe 20 years ago. And they're traded on the Johannesburg exchange, and there's actually a structural problem with the exchange because they become such a large component, about 20, maybe it's down a little now, maybe 19 or 20% of the exchanges now Naspers. They're having trouble where people, wealth managers don't want to own the ETFs. They're running into structural problems. They can't get bigger. They've become the largest company in South Africa, and what they primarily do is own Tencent shares. So they're trading at something quite extreme, like a 60 to 70% discount to the value, the true, not even the value of Tencent, because Tencent trades a discount to its value, but the price of the Tencent shares. So the NAV of the stock they own is like 3x the price of Naspers. So that gap may or may not close, but Tencent will continue growing. So this becomes just a question of where you want to sit on this, on this chain. So there are great investors who own Tencent, there are great investors who own Prosus, and there are great investors who own Naspers. And you might get a little spring with Prosus if it works. You might get a big spring with Naspers if it works, or it may just trade at a persistent discount. But at least you'll have growth in the underlier. So Tencent is a growing firm. Tencent will be much larger in 10 years than it is today. And so that's the difference between sort of just taking a Graham approach and saying, here are the fundamentals, but you don't know, but there's no growth involved, so it might never re-rate, versus Naspers, which will eventually be pulled up because of the growth of Tencent.